Hey everyone, this is Isaac. I'm CEO at Trullion, and today on AI Accounting Intelligence, we'll be talking with real people about real things related to AI and the impact on the accounting industry. Stay tuned. Okay, hey everyone. I'm here with Alex Oppenheimer today. Alex, it's good to see you. Alex is general partner and founder of Verissimo Ventures, a very, very incredible and impressive early stage venture capital fund. I've known Alex for many years. I also know that you spent a lot of time at Morgan Stanley, worked on the Facebook IPO, NEA, one of the top venture capital firms in the world before going off on your own. So Alex, it's good to see you today and excited to talk.
Good to see you too, Isaac, and thanks for having me.
Alex, before we get started, on a scale of 1 to 10, how much do you love accountants?
How much do I love accountants? I would say great accountants, 10 out of 10. Not great accountants, 0 out of 10. It's very polarizing. There's a barbell distribution.
Amazing. So we're going to get into a lot today, really around the value and importance of accounting and finance more broadly at the early stage of venture-backed companies and even through the life cycle. But Alex, before we get into all the debits and credits and stuff, like tell us a little bit more about some of the highlights of your run at Verissimo. I know you're involved in Monday.com which was a fantastic story. Just a few of your, exciting high points in your journey.
Yeah, so I have to give credit where it's due. I grew up with a father who spent 25 years as a CFO, and so when I said bookings, when I meant billings, I got called out at the dinner table. And so sometimes I worked in investment banking and venture, but I'm not your standard banking and venture guy. Just given the rigor that I was exposed to, and then to this day. And have it enforced upon me. But yeah, that's what I grew up with. Studied engineering in college, and then and took I took one accounting class. That was it. But and then I joined Morgan Stanley, where they kind of teach you what you need to know. But I'm a business modeler. That's my background. I think about business models the same way that a mechanical engineer thinks about CAD models, of how do we create a digital representation of something that exists in real life. And so, you can build whatever financial model you want. It's always, not only is it garbage in, garbage out, but if it doesn't map to the mechanical reality, then it doesn't matter. And if it's also not grounded in the definitions of what actually matters, then you're also in trouble. So I spent 2 years at Morgan Stanley doing investment banking, and then I spent 3 years at NEA as a Series A, B, and C investor, mostly focused on enterprise software, and then moved to Israel in 2016. Worked for a year at a corporate VC, and then went out on my own and started advising and started doing this thing, which at the time was pretty new, called like strategic finance, where I've got this semi-operational skill set, having been in a lot of boardrooms and spent a lot of time working with portfolio companies, that I could share with them and bring them not just, hey, here's how to create a great deck and a great model to share with investors, but how do you actually build your business better? And so I spent years doing that, and pretty organically came back to the idea of starting a venture fund. I love working with companies. That's number one. And I just found that working with earlier stage companies, I could have a better and more efficient and frankly more fun impact doing what I call preventative medicine rather than like acute care. The problem is that it's hard to get paid for preventative medicine when there was never an issue in the first place. Much easier to, as I always say, the paradigm is the personal trainer versus the heart surgeon. And so the question is, how do you do well and, create value as a personal trainer? And the answer is you train Tom Brady. That's the answer. And then you get a piece of the upside. And so, companies need help early, even if they don't know it. And then rather than trying to negotiate them, I just realized that it's either, if I'm going to be the finance and financing voice, then I ought to show up with financing. And so I decided to raise my own early stage venture fund. And so now we launched Fund 1 in 2020, Fund 2 in 2022, and we're doing early stage enterprise software investments in Israel, the US, and Europe. We have team members in the US, team members in in Israel, and then a couple advisors in Europe. And I guess that's the story. I had the chance to, I guess, skipping back a little bit, but I did have the chance to work with Monday.com and a handful of other amazing
Amazing.
companies, and really rolling on my sleeves and getting a lot deeper than I did just as a VC board member, board observer. And that really helped crystallize what do companies really need to operate, not what do they just need to raise money.
Got it. Amazing. And I can, Alex and I met in the early days when I was starting Trullion, and you kind of had this really unique skill set. I think you called it strategic finance, where you could both invest and advise, but also help with a lot of the core finance function as companies get off the ground. And there's really not too many people doing that in the market at that time. And I think now you see a lot more people trying to get into that strategic finance in the early stage startup. Now, Alex, what I love about you is you're an engineer, a Stanford trained engineer, and like the way you talk about businesses is like this economic model, which kind of reminds me of when I was in physics class and they were teaching me velocity and acceleration and all that stuff. I didn't really remember. I'm sure you know better. Maybe some torque or some momentum or something like that. But like, just tell me more. How do you advise these early stage companies on this economic model? Like, how do you put it in plain terms, especially for an early stage company that really has no clue and probably isn't even thinking about economic models, out of the gate?
Yeah, I think the really important thing for founders to understand when they're even deciding to start a business, and again, as investors looking at founders, also really important that the reason you invest in a really early stage company is because there's a big market opportunity and the founding team is incredible, and maybe they've got a great product already that people like using. You don't invest in a company because you think that the founders are going to do a great job of managing their financial model and staying on top of their metrics. Like that could be a bonus, but that's not usually the thing that attracts you. And so running a company requires a ton of different functions. And you know that because down the road, if you look at a public company and you look at G&A, it's a big budget and they have a lot of people. And people say, oh, well, those companies need to do more things. And in my experience, it doesn't matter on the stage of the business. Yes, if you're a public company, there are more things you need to do than when you're a private company. But practically speaking, you got to do everything. And if you say, oh, that doesn't matter and we'll deal with it later, you're going to develop this deficiency that's going to be either difficult or painful or catastrophic to try to fix down the road. And so again, practically speaking, you've got a CEO and everything is the CEO's responsibility. And, maybe we've got a CTO and a chief product officer, but that's kind of it. And that doesn't mean that those other things that you might hire later, CFO, VP of finance, like chief accounting officer, that you might get later, it doesn't mean that that stuff doesn't matter now. It just means that it's not a big enough task that it requires having a person full-time on it. But what it does mean is then it's the CEO, CTO founding team's responsibility. And so, but it's not their strength. And so you've got what I call it a non-core competence, right? Where it's really important, but it's not the main driver of value in the business. But if you mess it up, it can be a major detractor for value later. And so frankly, that's our strategy is we're not going to help you build your product. That's your job. That's why we're investing in you, because we think you're awesome at that. We're not going to help you, do your sales. Like, again, we're not going to not help with that stuff. We'll give advice where we can, but we're going to help you with the blind spots, the things that you don't quite focus on yet, or really shouldn't focus on at the really early stage of the business. And one of those things is finance and accounting. So I always say that step 0, before you even decide to start a business, before you incorporate, think through what value are we delivering? And how much is it going to cost us to deliver that value? And how much are people going to be able to be willing to pay to receive that value? And if you can't answer that question clearly, then you probably shouldn't start the company. Now, again, instrumenting that, building that up, all that, yeah, that's a lot of work. And that's the process of building a company. But, it always starts, again, I'm an engineer, I'm a finance guy. Like, it starts with the model. People say, well, isn't it too early to build a model? We don't even have any numbers yet. I say, how are you going to know what numbers to track if you don't know what model they're going to end up going into, because we don't track numbers for fun. It's not just like who has the most metrics. It's what can we actually do with them. So I guess that's a long answer to your relatively short question, but it starts from even before you start the business of what value do we deliver. It's very economic focused, and is there a business to actually be built here?
Got it. Okay, awesome. So Alex, on the economic model you're talking, I'm picturing a founder that has this great idea, this great enthusiasm, and the challenge that you're giving to this founder or this team is to create the economic model really for the sake of thinking through your KPIs and even setting up a framework for future tracking, even though there's a few customers or some early traction, right? So I hear that. Now, let's say you do write the check. Alex, let's say you lead a round or you join, call it a $3 million seed round, right? This company has between 100,000 and 1 million in recurring revenue. Um, how much accounting do you actually expect from them? Like, do you expect them to have a balance sheet, cash flow, income statement? Do you expect them to have an audit? Like, what is the definition of the accounting that's needed or expected at that stage?
So most of the time, and what we encourage our early stage founders to do when we come in from day one is you got to get some outsourced bookkeeping, accounting help. You're not going to hire that. You're not going to hire a controller from day one. That's not going to be your fourth employee in your company unless you're running an accounting software startup, maybe. But we often see that people use these outsourced accountants, outsourced controllers, outsourced CFOs, and it's a mixed bag. You definitely don't need an audit, I'll say that, but it's a mixed bag. We see some outsourced CFOs who try to do more, but then they're actually really lazy about it, and they just plug everything into some template model that has no bearing on the business. They try to do a bunch of modeling for the company without really understanding the business, and then they sacrifice quality on just getting the historical numbers right. I've seen this many, many times where I'm like, we don't, they're trying to build some forward-looking model with some really basic, assumptions and no mechanical bearing on the reality of the business. And meanwhile, you look at the historicals and they just don't make sense. And if you show that to a downstream, Series A investor, and your historicals on the cost side are not right, like it's a bad look. So that stuff's got to be right. What I always encourage is collect more data. And one of the things that I've seen time and time again is I'm like, okay, yeah, before you send anything to potential new investors, like send me the P&L, and they'll share it, and it has one line that says payroll expenses. Company has 12 employees and it just says payroll expenses. And that's like 80% of their costs every month. Like, that doesn't tell me anything about the business. Ultimately, what we want to understand in the early days of the company is what is the economic force driving this business and the potential that it represents. And that economic piece honestly becomes less important as a business scales, because the cash starts to fall out and the traditional accounting metrics start to do a better job of describing what's going on in the business. But early on, like, if you can't prove that your unit economics positive, you've got a big problem. And if most of your cost sits in your employees, you need to do this difficult exercise. And I know, Isaac, you've lived this, where, okay, we've got 4 employees, and one of the CEO, and the CEO does product, the CEO does HR, the CEO does sales, right? Like the CEO does finance. Like, how do you categorize that into, sales and marketing, R&D, G&A? Like, it's not so easy. I've had companies say, our CAC is 0 right now because, I do all the sales and I'm the founder and CEO. And I'm like, your time is extremely valuable and expensive. It's not 0. And we need to figure out, okay, maybe we don't know exactly how to calculate that. Okay, you're spending, 18 hours a week out of the 70 hours a week that you're working on sales and your salary, but that doesn't really represent your value. What it's really about is you think through, what's this going to look like when we have a sales team? And it's much easier to intuit around CAC, what is your customer acquisition cost, often, than it is to be categorizing things accurately with a sub-sized team into sales and marketing expense. And so you got to kind of live in these three worlds, right? World one is cash. Like, is money coming in? Is money going out? Like, that's really important. Number two is the accounting reality. Like, are your books accurate? Are you doing cash accounting? Are you doing cost accounting? Like, a lot of founders don't even know which one they're doing. And the outsourced finance teams that they bring on make a lot of mistakes. And I think a lot of founders I work with, they're often like blown away at the lack of quality. They're like, we thought this would be solved by now. Like, shouldn't this be easy? And the truth is, the more detail you get into, you realize like it's really not that easy. It's not that simple. There's a lot of judgment calls. There's a lot of nuance. And then the other thing that really matters for an early stage company is that economic model, where I think the mistake that you might make, even if you start with the economic model, okay, are we delivering value? Can we get paid for it? Can we deliver it for less than it costs us to make it and to sell it? You say, okay, yes, check. And then you never come back to feeding that model. It just becomes the GAAP accounting model. And that doesn't represent the business, honestly, until pretty late in the game. Like, it's an important picture of the business and it is a strong reality. But again, we live in a world of unit economics in the venture game. And the whole point is that, yes, we're unprofitable now, but let me show you why this $4 million a year we're spending on technology investment is going to stay at $4 million a year when our revenue goes from $100,000 a year to $100 million a year. And that becomes really, really interesting.
Got it. Okay, I have more of a theoretical question. I've actually, been on a couple of these podcasts before where I've heard people, um, one of David's friends especially, bash GAAP, right? The GAAP reporting standard. So we're not going to do that, but we are going to ask some questions around the kind of the viability and usefulness of GAAP. So you talked about, like, as a early stage founder, at some point you will transition from what you called cash to traditional accounting, right? And so when you say traditional accounting, I'm thinking then you have to move towards kind of like GAAP reporting, IFRS if you're international. I guess one question
Yeah.
I have is, do you think that you talk about economic reality a lot? Like, do you think that GAAP is closer to economic reality than cash, or is it just like something we have to do, or is it a little bit of both? Um, what is
So
that
the good
like?
news is,
Like, do you actually see a
uh,
better picture of the business?
yeah.
Yeah.
So in most businesses, especially technology businesses, especially software businesses, on the cost side, the good news is that it's pretty much the same. You might get some net terms on something, but most of your costs again are employees. So that's not like a big difference between the accrual and the cash side. So
Okay.
that's simple. Um, I have good things to say about GAAP. It just happens to be like 90 years old. And I always say to people that what I think, again, not an accountant, but the two biggest innovations of, because what was there before GAAP, right? It was just cash accounting. What money comes in, what money goes out. And so what I talk about is the two best innovations of GAAP are revenue recognition and this concept of revenue versus just when cash comes in, and then depreciation and having amortization schedules. And on the revenue side, again, a lot of people don't get what revenue is. Revenue represents what's earned. And we do that by when it's delivered. Now, again, you step into the software world, like especially SaaS, like what does that even mean? The truth is that software is service. So it's actually not that complicated. But the way that it's priced, the way that it's sold, there ends up being some confusion there. But it's a very powerful idea, this idea of revenue. It's a again, correct me if I'm wrong, but it's an invented concept of revenue. And I think that's a great innovation. And then having depreciation and amortization just gives you a much better understanding of what's really going on for a business. What are they earning and what are they using, right? You buy a truck for your business, you're going to depreciate it over 10 years. Like you weren't unprofitable in that year, right? Like that you bought it just because the cash went out the door then. So I think that GAP's important. It has its place, but with the onslaught of new technologies come an onslaught of new business models. And we can use those concepts that GAP pioneered and really take them to the next level. Now, that definitely creates opportunities for silly, made up. I mean, I'll pick on a company that just announced they're filing for bankruptcy, community adjusted EBITDA. Like I get what they were trying
Oh,
to do.
wow.
There's another company that they said they had ARR, and the world was like, you are not a software business, you do not have ARR. But if you really understand what ARR is, annualized recurring revenue, they do have ARR. They just don't have the margin profile of a software company. So there's all these things, and I think it's good to push the limits on it and see. You just have to make sure that you're fundamentally grounded and sound in the concepts and theory that are driving any of these newer, more innovative metrics. But I think that, every once in a while you get like just a vanilla down the middle software company, and they're selling on an annual subscriptions, and it's like, really, okay, like this cake has been baked before. We don't need to reinvent the wheel. It never works quite as well or as simply as people think it does once they start actually writing contracts. That's another thing that's really important. Like, what is in the contract, and is that going to look good in your ARR math? Is that going to look good in your recognized revenue calculations? So, there's a lot of philosophical stuff, and that's why I actually, when I talk to my founders, I explain them what I just said about what revenue is, and what verbs do you use with revenue? Like, do you have revenue? No, you earn revenue and then you recognize revenue. Like, you don't have it, you don't get it. You're not at it right now. You are at ARR, and I can talk about ARR and how people make all sorts of mistakes around that. And also, you alluded to this before when you mentioned physics. I have a slide in one of my presentations that I've been working on for 10 years that talks about different elements of SaaS, where I have accounting terms and integral symbols on the same slide. And I'm happy to get into that more of what that means. But I think that's the sort of stuff that it creates an opportunity to push and to get more creative, but again, stay grounded in reality. It's like, I always say, people say, oh, like, is it art or science? Like, often when people are talking about early stage investing, is it art or science? And I'm like, it's art, but there's this place called Juilliard. Art isn't just whatever people feel like. There is a method, and there is a skill, and there is such thing as intentional, good, fundamentally sound art. So it requires a lot of education and understanding to do good art, in my opinion.
Amazing. I love it. So you heard it here. We've got a vote. We've got a pro gap vote um, on this podcast today. I'm with you,
I
Alex.
do
Like
think it needs to be
I
updated.
like gap. I think yeah, for sure. So we'll talk about it in a second. Like I think the point is
Why don't we have a definition of ARR and gap? That's a question that comes a lot. And if you actually saw what these CPQ systems look like and CRMs look like and sales contracts look like, you would know why we don't have a gap definition of ARR, because it's like it's too complicated at this point to really understand. It's too nuanced. There's really too many variables involved. Every business is different. I talk to founders too about, are you an MRR business or an ARR business? Like, well, what's the difference? I'm like, the difference is a factor of 12, objectively speaking. In fact, ARR is calculated based on just looking at your monthly revenue and multiplying it by 12. But it could also be looking at your weekly revenue and multiplying it by 52, or your hourly revenue, or whatever you want. But when you talk about ARR, there's this annualized idea. And so if customers are coming and signing up for 2 months and then leaving, and that's what half your customers are doing, then do you really have can you annualize that? Like, no, it's not going to last a year. Now, again, if you have 100% of your customers on 1 year plus contracts, then like, yeah, that's ARR. Great. Like, you can annualize that. So there's a lot of these little points and challenges that come up.
got it. I hear it. So I guess for those founders out there, just in terms of the two things Alex talked about, one, revenue recognition, and two, depreciation. I find like in my experience, like there's not that much to depreciate in the early years. Like maybe you get some equipment, wouldn't worry too much. But as you start to get into bigger things like trucks and leasing and stuff like that, the depreciation becomes super powerful. And then on the revenue recognition side, Yeah, RevRec in SaaS is huge. So I'll just give you one example. Like if you have an opt out in a contract, let's say you're counting it as 1 year revenue, but they have an opt out after 6 months, Gap RevRec will wipe out the last 6 months because you have an opt out clause. And so, it's interesting. Like in retrospect, when you're an early stage founder, you have a lot of pilots. You might like, especially in enterprise software, you have a lot of potential customers that they have an opt out, or you might have like two specific obligations to give them. And if that was in a gap revenue model, like it would be discounted. But to Alex's point, like I think the good investors are really looking for, how you think, whether you're able to secure that, kind of the economics of the business and the potential in the future. Now, what I'm interested, Alex, you talk about gap evolving, is that in like you talked about two things, revenue and depreciation. Can you think of like a third or a fourth thing where Gap should probably get on this pretty quickly, whether it's on the revenue or the expense side? Like what's a rule we should push for in Gap right now that would help, an early stage investor, really any investor, understand a business better?
I'll speak on the conceptual side, even though I know that this is not entirely practical. But one of the things that we run into a lot is, what we call CAC attribution, right? What's the customer acquisition cost, and how do you attribute that to the customers that you're actually acquiring? Now, instrumenting this for a business is very, very difficult. But the reality is that a lot of people are like, oh, like what's your, they'll say, what's your CAC payback, or what's your, your SaaS magic number? And they just say, oh yeah, you just take the sales and marketing expense from the previous month or the previous quarter or whatever you have. Now, if you are a 2-week sales cycle business, then you would actually want to take your sales and marketing expense from the same month, which is, again, in theory, what you should do. And then if you're a year-long sales cycle business, then you probably want to average that sales and marketing cost over the last year based versus when that deal is closed. And so if you would actually align the CAC with the economic reality and the timing of the business, which again, very difficult to do this, nearly impossible. The instrumentation is very, very difficult. This would paint a much better picture of the company. I'm trying to think of something maybe a little bit more doable than that, but that's the first thing that comes to mind is like solving that CAC attribution issue.
I love it. So, and I'll tell you, CAC, you've mentioned it a couple times, customer acquisition cost. Again, there's just a plethora of metrics. We call it finance. I'm using air quotes here. But it's really just all the different metrics like CAC and ARR that are non-GAAP, but that are really critical to running businesses, especially in SaaS and software. Um, Alex, you mentioned like the founder being included in CAC. For anyone out there who's entrepreneurial or working with entrepreneurs, uh, we're always in sales at the beginning. I am included in CAC, but later on, I still do selling, but our CAC is low because I don't tell anyone I'm involved. Usually people like, they try to be the hero and stuff and like, talk about the sale. But if I pretend like I'm not selling, it's actually better for our CAC. So just a little hack there, and you make your sales and your marketing team look a little bit better. You mentioned audit earlier. You said you don't need a financial audit, right? Let's talk a little bit about governance, right? Because, writing a seed check has to be pretty vulnerable, especially the first few times, right? Especially when you have your own fund now. You're giving money to someone who's likely never run a business before. It's a lot of money. I mean, we see on TechCrunch like 3 million, 5 million, 4 million, like every day. That's a lot of money that you're entrusting to someone. And they're like sacrificing a lot of their livelihood just to focus on this business. So like, okay, I get it. You don't need an audit, but maybe what type of governance is needed at that early stage in your responsibility as an investor, especially as it relates to finance? And then at what point, what's the tipping
Yep.
point for needing an audit from your perspective in these businesses?
Yeah. So I think there's a big question on what actually is an audit. I assume most of the listeners here have at least probably a strong idea of what that is. But, I think that when you're invested in a company, someone needs to be providing some sort of oversight on what money is going where. We just invested in a company. I say company, right? We invested in a very young founder. He just graduated from college. Very, very smart engineer. And he's like, well, how much should I pay myself? Right. And I'm like, glad he asked, because he's like, well, if I accepted my job offer at, top 5 global tech firm, they'd pay me this much, so I should pay myself the same. And I'm like, oh, no, absolutely not. Like, not even close, buddy. And so there a lot of it comes down to, again, most people, when they invest in a really early stage company, they may not want to join the board. The founders may not be interested in having them on the board. Advice to founders: you want to work with people that you would want to have on your board. Now, how you set up your governance for the long-term success of your business is a different conversation, but you should want to be engaged. And so what I always recommend my founders, even if we do a safe round, is create a quasi board. That's what I call it. And bring together your key stakeholders, whether, it's the whole founding team or even just part of the founding team or another employee who's really instrumental, and then any really key advisors that are involved, and then your main sources of capital, and just come together. And it solves so many problems that when you split it apart, get really messy. One of those problems is governance. Like, not everything's nefarious, but people make mistakes. People have different expectations, and it results in a lot of potential gaps if you're not meeting regularly to discuss something. There are situations where, I was on with a founder, and we don't have a board, but me and one other investor are like the quasi board, and he's a sole founder. And he's like, I need to move for this and this reason. And in order to, take care, my family needs this, and it's going to cost more. And like, okay, the fact that he asked is what's important at that stage. That, yes, I said, look, if you need to pay yourself another $2,000 a month so that you can live in a place where you and your family will be just more productive and better off, then that's fine. Like, do that, but it's good to ask. So I think creating that relationship is the most important thing. Ultimately, starting a company, someone asked me about, could you, in an early stage round, spinning out something where the founder still owns the services piece, but then they raise money for the other? I'm like, no, absolutely not. Starting a company, and Isaac, you could attest to this better than I can. Starting a company is a tremendous amount of work. It's a huge undertaking. Even if you're really, really good, you're definitely going to see a lot of challenges, and you still may not have success. If not everyone is pointed in the same direction, which requires ability, it requires willpower and desire, and it requires communication to make sure that happens, that everyone's pointed in the same direction. As soon as someone's motivated by that, and someone's motivated by that, and someone doesn't understand this and why you did that, then you're just asking for trouble. And it's like, early stage companies, the whole point is that they move really fast. Otherwise, there'd be no reason to do it. At one time, a founder said to me, hey, we have 6 engineers working on this problem, and Intel put 600 engineers on it and they couldn't solve it. And I was like, yeah, that's kind of the point, right? Some problems are 6 engineer problems, and some problems are 600 engineer problems. And there's very little overlap between the two. The whole point is agility and moving fast. And so if you think about an airplane traveling at 600 miles an hour, or the spaceship, if some part of that airplane is pointed in the wrong direction, right? One of the ailerons is not connected, but like, you're done. Like, you have a huge problem on your hands. So I don't think that early stage companies need an audit. Exactly when you should get your first audit, I don't know if I can answer that in an absolute way, but in an early stage company, it's not going to tell you a lot. Like, we have to have our fund audited, and the audit report is comical because our operations are extremely simple as a small fund. So it's not worth the money. It's not worth the overhead of doing that. But a big but, like, I, as the investor, and a lot of investors may not do this, like, okay, let's look at what your customers are actually paying you. And like, let's make sure we're all on the same page. Let's make sure that, like, if you tell me you have an annual contract, as investors, we all assume that means it was paid up front as an annual contract. If it's not, then we've got issues, and we've got a miscommunication there. And our expectations are not going to be met when we realize that it churned after 4 months, even though it was an annual contract. How can that happen? There's just a lot of opportunities for things to go wrong. So I don't I wish I had a better answer. The best answer that I have is that founders should educate themselves on some of the core accounting concepts. It's not that hard. It's not that much work. We have a thing on our website at verissimo.vc in the resources section that's, accounting like SaaS related accounting definitions. And you can look at that for 10 minutes and you'll go, and it just goes down. It says, what is GAAP revenue? What's ARR, MRR, bookings, billings, collections, backlog, deferred revenue, and reoccurring revenue? And all of those things, it just, again, takes 10 minutes to read. Okay, so now I have a better understanding of what that really means. And, people often take maybe a little too much guidance from their investors. They let things slide. So yeah, that's my long answer to a short question.
Yeah, no, I really appreciate it. I mean, it brings up a bigger question. We'll unpack it another day, but it's like you really don't need it's referring to an audit as overhead, right? Like I am an investor, I'm a steward of capital, like that's what you are, and you are not that concerned with the audit at a certain stage, right? And so maybe it's a few million in ARR, maybe it's 10 million, maybe it's 20 million, but it's this idea that what you care about is more just the compliance aspect, the company or the founder like being accountable for risk in the business to investors. And so you kind of have to self-define the audit, I guess you could say, at the early stage, like what actually needs to happen. So it may be different for different businesses. Maybe it's less financial in the early days and more just around the individuals in the room. I also think it's interesting because you talked about outsourced accounting and outsourced bookkeeper. I mean, now we're at Series B, our company Trullion, and we have these board meetings. And at first I was like, board meetings, check the box. But now they became super valuable. We get super good feedback from investors. And also, one of our lawyers helps organize them, right? Like someone on our legal team, and it's free of charge. It's actually a free service. Of course, we pay them for other things, but I'm saying like they help organize board meeting notes. They get everyone together. They do a lot of the scheduling and stuff. So that could be something for like earlier stage finance and outsourced bookkeepers to think about is just talking with that early stage founder about, hey, do you want me to organize a 30-minute like advisory board? And I'll just put together like a couple slides. Would that be helpful? Because a lot of these founders and entrepreneurs, they don't have time, but they could build so much goodwill and so much better discipline, like with these practices. So I totally hear your point about the audit. Now, my question on that is more like a hot button, which is, do you like you talked about WeWork earlier, right? Community adjusted EBITDA. And that's probably the poster child for all of this. But is private, kind of venture investing, are companies that are venture backed becoming more risky because of lack of compliance and internal controls? I mean, we've seen fraud, right? I mean, Theranos, again, these are extremes like Theranos and WeWork, but also you realize this, like there's some early stage companies that mess with financials and they'll raise like a Series B or a Series C and it'll be semi fraudulent or at least misleading. And so, do you see like a,
Yeah.
a certain trend one way or another, or is it just proportional to the amount of companies that are getting back these days?
Yeah, I think there's two main drivers at play. The first is that high growth, early stage companies are by their nature aspirational. And to be aspirational means to live in a future reality. And that's just asking for trouble. We're not there yet, but we think that's what it's going to look like. And by the way, that's what ARR is. We're saying, what will we have earned in a year if everything stays the same right now? So that's one element. The other element is the kind of the cult of the founder and the I don't know what to call it, unhinged charisma that can be encouraged and promoted in the founder community. There's a high overlap of people who are wildly charismatic, but who do not have the moral compass to take on the responsibility to properly channel that charisma into something that is, on the straight arrow, I guess. And so you combine those together and like, it was like, oh, these founders, they lied about this. Like, look, the stuff's not accurate. Everything's a projection. But there's a line, and there's a clear line where it's like, yeah, that's okay, and then there's another line where it's like, yeah, that's not okay. I one time I was, looking, it was like my second meeting with a company that I was looking at advising a few years ago. And I was I had only met with like the CEO and the COO. And then I was sitting with some of the other members of the team, and they were on the data team, and they were driving and reporting financial metrics. What's our CAC payback? Right. That's an operational KPI, but it's a financial metric. It really speaks to the financial health of the business and the customer base. And they were not being, it wasn't any malice. There was just a complete and utter lack of understanding of what is revenue and what is cash. And they said, yeah, our CAC payback is X number of months because some people sign up for multi-month plans. I was like, huh? Like, CAC payback is, again, there's no rules on this. It's not a gap definition, but the community generally understands that it's based on earned revenue. So if you're saying that just because you got someone to pay and you have low margin or high margins, low marginal cost, then like, oh yeah, then we got our CAC payback. Like, yeah, I mean, okay, fine. You got your cash back and it took this many months. Yeah, but let's just talk about both. Right. I had another situation where with a founder, he was talking about, actually a similar thing, like on how to build your cohorts. And it was whether the cohorts are based on when the user signs up or based on when the user becomes a customer and actually starts paying. The problem is that the general understanding is that cohorts do not grow. That's kind of the definition of a cohort, right? So we have these people that signed up in October of 2023. That will always be that group of people. It will never change. The people can just leave that cohort. And that's what people imagine. Now, he wasn't being disingenuous. He wasn't trying to deceive anyone, but it's a fine line to walk. And so I'm a huge proponent of like more data. Like, you have a strong argument for why you think the sign-up cohort is a valuable leading metric for your business. And I hear it, and you're correct that it is. But you at least need to call it out for what it is. Because when you start reporting, net revenue retention and things like that, then again, people expect one thing, which oftentimes people don't even know what to expect. Like, net revenue retention has become all the rage, or net dollar retention. And there's 17 different ways to calculate it correctly and another 20 ways to calculate it incorrectly. It's really like, this company has 142% net revenue retention. And it's like, there are probably some people listening to this going, no, this is how you calculate it. Like, are you sure? Right? There's no legal definition. And it's different for each business. So anyway, that's, it's important, I guess, again, to just keep everyone on the same page, track more data. I think, like Isaac suggested, it's super valuable early days. Bring in that outsourced accounting team with your investors, because that person's not on the team. The CEO and them are not sitting next to each other. And so when that then goes to the investors and that person's not in the room, and now the CEO has to represent it, and it's just asking for trouble. It is asking for trouble. I had this with a company recently. I'm a small investor in a company, and like, what they were showing was just not helpful. It wasn't inaccurate. It just wasn't helpful, and it didn't look good. And I'm like, here's what people are it's gonna stick out and it's gonna look funny. And then you want to change. Like, I'm like, if you change your projections, if you're a seed or Series A's company and you go and you raise money and say, we're gonna 2 million of ARR and we're gonna grow to 8 million of ARR, and you raise money at that moment, and then you only grow to 6 million of ARR, people are not gonna be that upset. It's fine. Like, you tripled, great. It's all good. Like, yeah, I mean, we thought we were going to do 8, we did 6. All right, that's still great. Like, yeah, someone might get upset, but that's their problem. It's fine. And that's all in the realm of being aspirational and living in the future. And you got to hope for the best, otherwise you're in the wrong business. But if you're changing historical numbers, historical costs especially, that's a big red flag. Because now I can't trust anything. That stuff should be simple. That stuff's pretty objective. What did we pay for? Like, okay, we got a refund later, like, for $600,000 we got a refund? Like, no, we didn't. Like that stuff's got to be right in order to engender trust. And then the discussion happens to make sure that we're all on the same page in what we're looking at into the future.
Got it. So fortunately, you haven't had to deal with the pre-IPO EBITDA games, or I guess like the fake blood banks or whatever else is going on. But like more about the founders first understanding what these metrics mean and maybe being a little bit vulnerable to debate them. Like you could put the data up in front, but you have to agree on what CAC payback is or what the cost side is. And so
Yeah.
it's not really as much of a concern of fraud. It's more like, let's make sure we're talking about the same thing. Because it could be a slippery slope.
Let me just give two more examples on this, or like one or two more examples, which is tendencies of a founder early stage. Like one tendency is that they'll see some blog post that talks about, oh, here's how you calculate this. And then they take that as if it's like a legal definition, and then they want to play a game around it. Well, it will look like this if we do that. And it's like, it doesn't matter what it looks like. It matters what really is going on the ground. And so one example of that, and Bill Gurley did a great job of calling this out years ago, that all these consumer internet, direct consumer, whatever companies and like service businesses, they were saying, hey, we had someone sign up for $100 and then we gave them a $50 discount. And they said, yeah, that $50 is marketing. Like, no, that's called contra revenue. And it comes out of revenue. You never earned it. It never existed. And so you can't annualize against that and try to like hide stuff and play these games.
Got it. And by the way, to full circle, revenue recognition does account for a lot of those things. Customer acquisition, certain types of revenue acquisition costs and sales commissions and things that can, kind of be offset a little bit with the actual revenue that you're trying to acquire with it. Alex, last thing, and hopefully you've got a blog on this, or maybe one coming at some point. AI, right? AI. It's all we talk about. You are on the front lines. Give me an example of a real live finance or accounting AI use case that you've seen, played with, looked at, and then maybe one that you think is like super attainable and you're hoping someone can crack it soon.
Yeah. So the backdrop of this, I would say, is that accounting is hard because it touches regulatory, right? GAAP is I don't know if it's fully considered a regulatory body, but right, GAAP is it's a standard, and for a good reason, standards move slow and regulatory bodies move slow and tax systems move slowly, and that's how they should be. But businesses move quickly, and that creates a lot of tension. The result is that you need to have people who are up to date with what's going on and also understand the nuances of what's changing on the ground in businesses. And so, to make an analogy to autonomous vehicles, I don't think we're going to get to level 5, full autonomy, no intervention, no steering wheel, no pedals, nothing, in the near term. And I think that the best options are to be able to connect these different systems. There's multiple sources of truth. This is why it makes things hard, because things need to sync together, and then it needs to speak to the rules and abide by guidelines. And it's just very hard for any AI system. It requires a ton of guidance. And so where I think the near to midterm opportunity is creating a augmented human system, something that picks on a part of the human's job that humans maybe aren't good at, but computers are good at, and automates and uses AI to just make that easier and faster. I remember I was advising a company years ago, and the outsourced accounting firm they were using sent 100 questions. 100 questions. It was a spreadsheet of questions about different expenses in the business and where they go and what is this and should we look at it that way. And I was like, no founder's going to take the time to answer that. I mean, like at an early stage, you got to sell, you got to build. Like no one's going to answer that. And so I think that the near-term opportunity is to be able to take some of those some of those items on the ground. Don't take the human totally out of the loop. Augment the human's abilities where computers are really good at stuff and AI can be useful, keeping in its lane. I don't know if that's exactly what you're looking for, but there's also this company
No,
that's
I think
headquartered in Tel Aviv called
right.
Trullion, that that's doing a great job of helping create this truth.
Yeah, no, I appreciate it. And full disclosure, Alex is one of the investors in Trullion, our company. And on the AI front, like we have been talking about AI in finance and accounting for 4 years now, and we've probably been talking about it even before. And so it is really cool to see some of the incremental wins and milestones in AI. Whether it's like the Chat GPT kind of Gen AI areas or just the more accurate automations around documents and stuff like that. So Alex and I have been talking about this for a while. Alex, I mean that's a lot to chew on. That is great stuff. I've been excited to talk to you today. I think that a few things that Alex mentioned, just for anyone listening, Verissimo.vc, a lot of these metrics that Alex has talked about are available on the website. Again, there's a lot of smart finance and accounting people, but I can tell you that if you read Alex's stuff on Medium and go to Verissimo.vc and look at this, there is a very, very strong codification and logic behind a lot of these SaaS metrics. And I can tell you that a lot of companies, have kind of followed Alex's guidelines to success. I can also say that Alex, you're one of the few kind of finance professionals, banking and VC background that really, really appreciates accounting and understands the value of it. So that's probably why we get along. But anyway, Alex, any parting words or words of wisdom for our accounting listeners on the line?
I guess the main thing is to stay human and understand that the value that humans bring is in the nuance. Isaac, we've talked about this before, that accounting was one of the first use cases ever of software because it's a lot of addition, subtraction, multiplication, and division at scale, and that's what computers were invented for. So the problem is that policy was built around those original computers, and now the computers are much better. The businesses are more complicated. The policy and regulations have not kept up, and that's where accountants themselves really have an opportunity to step up and differentiate themselves and live in that world of nuance and I would say measured creativity on how to best represent new businesses, interesting business models, the influx of technology and AI in the future world, while also maintaining, a sound fundamental grounding.
Alex, if anyone wants to get in touch with you, early stage founders, or read about you or some of your work, where should they find you?
So I'm on LinkedIn, Alex Oppenheimer. My fund is called Verissimo Ventures, Verissimo.vc. I also have a Substack, which is alexoppenheimer.substack.com. It's called SaaS Engineering. That's about it. We also have an investment submission form on our website. And I'm also on Twitter.
Amazing. Thanks, Alex. Appreciate your time today.
Thank you, Isaac.